Okay, we just finished reading book 2 in our 24 books in 2024 book challenge, The Investment Answer. A great little book, just short and sweet, 70 pages. If you haven't read it or if you didn't have a chance to buy it or whatever, I'd definitely encourage you to go back and get this one for the future. Just a fantastic book, lots of great information in here. I'll tell you, we could do probably a really long review on this book because there is so much in here to talk about, so many things that people ask me questions about and everything that I'm probably going to have to do 3 or 4 more videos just on this book on certain things. But I'll tell you how I ran across this book. So in here you read something about the efficient market hypothesis, which is this investment philosophy done by Nobel Prize winner Eugene Fama. And Evidence Advisors is founded in what they call evidence-based investing. And evidence-based investing, when I was learning about that, I discovered this book. And a lot of the stuff in this book is what the philosophy of evidence advisors is, and many other firms like us who subscribe to a lot of these kind of philosophies in this book. So a really good book. Let's go over what the decisions are in here that he talks about, 5 decisions. I've added 2 questions to that, those 5 questions or 5 decisions. And the 2 questions that I would add to it are, what's the purpose of the money that you're investing? And how long do you have to invest it? So those 2 questions also, in addition to the 5 in here, are really important, I think. Sometimes people they're just investing and they're just chasing a return and they don't really know what the purpose of this money is long term. And you really have to put a name to that account, a name to that dollar, a purpose to that account as far as what it's for and the time frame that you're going to have that account be invested. And that'll really help you with a lot of these other decisions. Okay. All right, let's go over the 5 decisions. Decision number 1 in the book is the DIY decision. Should you be a DIY investor? Okay, people love do it yourself. Everybody wants to, either save money or, try to do these projects on their own and everything. And, is investing something that you should do yourself? And I don't know. I mean, I ask people this all the time. If I have new clients or new people I'm working with, I'll ask them, have you ever thought about just doing this yourself? Because you can do it. You can anybody today can go online and get an account with Schwab or Fidelity or any of these other online brokerages that are out there. Link your bank account, throw some money in there, and start buying things. I mean, you're investing at that point. And it's not, you don't have to have an advisor to set that up. But when I ask people that question, there's really a bunch of reasons that sometimes people say, nah, I don't want to be a DIYer. Number 1 is just it takes a lot of time. You need certain resources to do it yourself. Then there's education. I mean, you would really have to educate yourself about all the different choices that are out there to have as investments. Experience, I think, is a big one. Everybody has their own experience, but an advisor is going to have the experience of dealing with lots of other people's, issues and helping them with planning and all that kind of stuff that they can draw from. And then there's a certain amount of skill it takes to just work through a lot of the challenges of financial planning. So there's different reasons why you would not want to be a DIYer, all right? But one of the reasons that people also try to do it themselves is because it's so confusing to find somebody, all right? Finding an advisor can be really hard because there's so many different designations and all kinds of different things that go into finding someone. Anybody can call themselves a financial advisor. If you go to this website, this FINRA website, which is where you do broker check, it's the Financial Industry National Regulatory Authority. Okay, that's FINRA. On that site, they have a list of designations that people can look at to see, if they would want to have somebody with that designations. There's over 150 designations on there. And some of them, honestly, I've read through them, sound really made up. All right, so you have to really gauge whether or not some of these designations are real. I'll tell you what probably the top 3 are, which is the CFA, the CFP, and the CHFC. I think most people in the advisor community would agree those are the top ones. CFA, they don't necessarily tend to work with individuals. They might work for an investment company, building and managing portfolios and things that are kind of behind the scenes. A lot of CFAs would be doing that. I mean, there are CFAs that work with individual clients and everything, but you're not going to find a CFA is very hard to get. You're not really going to go looking for a CFA to manage your Schwab account necessarily. CFP obviously is the Certified Financial Planner. These are people that are very much involved with individual clients and managing wealth and doing financial planning. And same thing with the CHFC. It's just a little bit different designation. It's not earned in the same way. CFP is a board certified designation. So if you're looking for someone, I would suggest starting with CFP. You'll find people with different designations and some good, some bad. All right. Okay, the other thing is when you're trying to find an advisor to not be a DIYer, is trying to figure out, are these people fiduciaries? How do they get paid? What is their structure? Who do they work for? There's just all kinds of questions. And, a lot of times, and even the word independence now doesn't mean a whole lot, because you can be an independent contractor with a broker dealer or something. And there's sometimes not a lot of independence with that. So just make sure you ask, who do you work for? Are you the owner of the firm? Again, Evidence Advisors, registered investment advisory firm. I'm the owner. We don't have any affiliation with any broker dealers or anything like that. So and that doesn't mean that people who are registered representatives or insurance agents or anything like that are bad. I mean, there's lots of good people out there that you can find to work with, but the structure is very important. So always ask if if they work for a firm, if they earn commissions, and how they get paid, what their fee structures are. All those kind of things are really important to determine whether or not you should use that advisor. And I got to do another video on that, because there's so much there to talk about on who is a financial advisor. So we'll have to do another one on that, I think. The next thing is the asset allocation decision. This was the next one. So asset allocation, really just to sum that up, is basically how much do you put in stocks, bonds, and cash. Those are the three really broad categories. And the whole purpose of that is really to adjust your risk. Okay, asset allocation is about risk adjustment. And risk is the primary driver of your return on investment. So there's, the more risk, the more reward. You've heard that, and that's true. In investing, there's a way of determining whether or not a particular investment could potentially have higher returns than another one, and a lot of that has to do with risk. Unfortunately, there's not a super low risk investment that earns a very high return. It's just not like that. So asset allocation is about adjusting your risk. The next decision is the diversification decision. Now, this sometimes gets confused with asset allocation, but diversification decision is really, what do you put inside those three buckets? So you have your asset allocation of stocks, bonds, and cash. What do you put in the stock bucket? Well, how do you diversify that area? Do you use just US stocks? Do you use just large companies, small companies, international, value, growth? What do you do inside that bucket? What do you do inside the bond area? Do you use municipal bonds? Do you use corporates, long-term, short-term? And so there's a bunch of different things. And this is really where an advisor can come in and help you. Someone who really understands the different types of investments to help you with that asset allocation. So that's a very important part of the decision in the answer to how to invest is, what to choose inside that asset allocation. All right, the next decision he talks about in the book is active versus passive. So this is an ongoing debate all the time in the investment community. Should you pick an active manager, or should you just go with an index? Okay. Now, people who pick active managers, who like active managers, will give you lots and lots of arguments for why that's good. People who like indexing will give you a lot of arguments to why that's good. Just full disclosure, I'm on the index side. Okay, so I believe in the indexing concept. And in the book, that's also what they're promoting in the book, is the concept of index investing, which keeps things low. You're buying a broad mix of assets instead of having a manager pick inside an asset class. You keeps your cost low. There's a bunch of studies about how managers really don't beat their benchmarks over time, net of fees. So there's a lot of information in the book that I think he goes over really well about why you might want to be passive versus active. Do active managers sometimes beat their benchmarks and beat the market? Absolutely. Do they do it consistently over time? Studies say no, they don't. All right. So active versus passive is a decision you just have to make. And that goes back to the advisor. When you're finding an advisor, you really want to ask them that question. What do you do as an advisor? Do you pick managers, or are you doing index investing? That's a good question to ask somebody that you would work with. All right. Okay, the next one is the rebalancing decision. That's the last one. Rebalancing is really just goes back to, your risk. You don't want these investments to continue to be going in one direction away from how you originally set up your risk percentage or your risk allocation or your asset allocation. So someone managing a portfolio, if you were managing your own, you would want to, at a very minimum once a year, rebalance that portfolio back to the percentage that you originally chose. And if an advisor's doing it, they might do it, twice a year. They might do it every quarter. Probably not going to do it every single month. That might be a little too much, but there's all different philosophies and reasoning behind the timing of rebalancing. Some do it on a very strict, every quarter. So it's just no matter what has happened to the account, it gets done automatically. Sometimes it's sort of selective based on what's going on in the market. So there's different things that go on there, but an advisor who's helping you has their own way of doing it. And sometimes it's multiple ways. We tend to do it, every quarter, but if something's really different in the market for that time and there's an opportunity, then you can rebalance at that time too. So those were the 5 things in this book: the DIY decision, the asset allocation decision, the diversification decision, active versus passive, and rebalancing. And then of course, the other couple things that I mentioned there, make sure you give your account a purpose and make sure you have your time frame figured out. So this was just really, really good. I hope you enjoyed this book. Hope you got to get through it. There's some other really neat things in here in the book in the back. You might want to read the letters that the authors wrote and everything. So that's kind of a nice little insight on the book as well. All right, next book. I already started reading it. I would encourage you to get started. The Price You Pay for College. This one is quite a bit longer and it's small print. There's a lot in this book. It's going to definitely probably take me the entire couple weeks to get through it, but what I've started reading already I think is really, really valuable. So if you're a person who has kids getting ready for college, or you're thinking about college in any certain way, or you just want to know more about how to get into college and the cost of college and everything, then I would really encourage you to read this book. And we're going to get started here this weekend. Thanks again for joining the 24 books in 2024. And next time we'll be talking about this book. Please do some reviews. There's the links in the emails that I've sent you. If you want to just type some questions in there or let me know what you think about the books, that would be great. And have a great weekend and happy reading.